Can you share examples of how not worrying about the interest rates could affect people? I think you had a saying. What you call that? It was something about roulette.
Oh, rate roulette. Yeah. Well, I was telling you a story. This week I'm handling several stories. I've got loans in process, refinance of customers, and home buyers, and their behavior has been very interesting and something I've been trying to help them with. And I'll have to admit I haven't been entirely successful. Here's the basic scenario that we've seen in this recent week or two. I've got a refinance borrower, his loan's in process. And I suggested to him, you might want to get this rate locked. And he specifically said, no, I want to wait until the Fed meeting. I started a purchase loan beginning this week. Same thing on Tuesday. I gave this borrower some numbers that were very attractive. I mean, again, rates have already fallen. And I urged her, you might want to consider locking this. And again, she was of the same mind. No, I'm going to wait for the Fed meeting. What I try to impress upon both of them is, number one, what the Fed did this week does not directly correlate to long-term mortgages. That's not what they control in any direct fashion at all. Fed funds overnight borrowing rate's not the same as a 30-year borrowing rate. It's apples and oranges. Now, can it have a indirect effect over time? Well, yeah, sure. But what I was trying to get across to them both, and I've actually got a couple others in this regard too, who I basically said, look at where rates have been over the last month or two. In fact, with this one purchase transaction borrower, I first started talking to them about another property in June, and they're getting a second home loan where at that time the interest rate for those was in the sevens. It was about 7.25. I'm talking to her this week about 6 and 1/8. Look, you're enjoying a 1% improvement in your rate over what we thought you were going to get in June, but you ended up not pursuing that house. You're now in escrow, and here you are better than 1% lower. Watch out, because you know what tends to happen, as I've seen it over 4 decades. A lot of times when the Fed makes their announcement, again, the mortgage market, bond market's already priced in that expectation. And then what happens when they make the decision and announce it, oftentimes mortgage rates get worse, not better. And that happened this week. Now, did they jump up a lot? No, but they went up an eighth. So both my rebuy borrower, my purchase borrower, at least as of right now, because neither one of them has locked yet still, they're an eighth worse than if they did what I suggested earlier this week. So that's the game some homeowners fall into. And I really urge them not to do that, because they're forgetting about how a rate lock can be very, very good for you to protect yourself, protect you from upside risk. And yet the industry has evolved to where you can grab that upside risk protection. And if rates end up falling, not right after the Fed meeting, but maybe in the next week or two or month, then if your transaction is still in process, you'll have an opportunity to renegotiate that and get something better. But at least your upside risk is capped, it's protected.